Good morning, and welcome to the Energy Perspectives Group webinar hosted by InPlay Oil Corporation. This event will be recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here is Dan Steffens, who will introduce today's speaker.
Hi, everybody. We welcome April 15th. This is kind of an important day, and I just want to go over where we were 1 year ago. It's amazing how far we've come, but I want to remind everyone that on April 15th, 2020, the price of oil went under $20 a barrel. And by the end of April, the front month NYMEX contract, which was the May 20 contract, went negative. I didn't even think a futures contract could go negative, but it went negative. But in the real world, oil spot prices briefly dipped below $12 a barrel. And today, WTI opened at 62.73, and I saw that it went up back over 63 US. So it's been a wild ride, but I now believe the oil price risk is to the upside because in the post-pandemic world, demand for oil will rise quickly, and we are heading into a seasonal peak demand period for transportation fuels. Demand for oil is seasonal. It's not as seasonal as natural gas, but it is seasonal, and the summer is the high demand period. So now is a good time to add undervalued upstream companies to your portfolio, especially companies with production growth and free cash flow. So now I'll introduce our speaker. Our speaker today is Doug Bartoli. He's the president and CEO of InPlay Oil, one of the companies in our small cap growth portfolio that I've been covering for many years. InPlay is a perfect example of companies that survived 2020 and are now set to thrive in 2021. I've known Doug for over 10 years, and he has been working upstream oil and gas industry for over 30 years. We both survived several oil price cycles, but neither one of us has seen anything as bad as what happened in 2020. It's the biggest drop ever in oil demand and in the oil price. He began his career at Renaissance Energy that was acquired by Husky Energy while he was there. From there, he became the vice president of operations for True Energy Trust. You guys may remember when there was a lot of Canadian oil and gas trust. But before founding Vero Energy in 2005, Vero Energy then sold their gas assets to Velvet Energy, a company backed by Warburg Pincus, for approximately $200 million, and then Vero was sold to Torque Oil and Gas for approximately $200 million in 2012. Then later in 2012, in November of 2012, he founded InPlay Oil. The company generated solid production and proven reserve growth through 2019, and then the COVID-19 pandemic caused the largest decline in oil demand in history. Doug's team made the right moves early in 2020 to survive the pandemic-driven oil price decline, and InPlay is now in good shape and set to grow production again. Based on my forecast, InPlay should generate solid free cash flow from operations in a $60 per barrel oil market. So I'll turn it over to Doug now. It's all yours.
Thanks, Dan. Yeah, thanks for that introduction. And I agree with you on that. 2020 probably was the worst year I've ever seen, just the sizable collapse and the quickness of it all. And, just the markets in general and just the negativity around, how long this is going to last. And just, the oil and gas industry, of course, has had its other headwinds on top of all that. So, with that said, I'm extremely excited to be presenting here. I think the last time was about the middle of November, and that was after we just received our BDC term facility, and we started working towards drilling and getting back to the pre-COVID levels. I don't need to talk to your group about too much about pricing and where things are at there. I know Dan provides you guys with lots of information from analysts, from banks and other providers of what they're seeing and where demand is going. And, the one thing I will say is, there's a few little tidbits that I'm not sure Dan has said about, but oil isn't going anywhere too soon here. Let's all believe it, agree with that. But I mean, it was only less than a month ago when India said they're going to double their production from around their demand needs from 4.3 million to 8.7 million barrels by 2030. So pretty interesting stuff. I always go back to the industry isn't spending enough. The rig counts are down. to get back to these post-COVID demand levels, specifically, in Canada and the US. Again, we need to get through some of the surplus on OPEC. There's a lack of access to capital, both debt and equity. It's not, there's a little bit more, but it's still not there. A little bit of Canada-centric type information. Our lighter crudes are off 15 to 20% from the highs. Our differentials are right now hovering in the 5% of WTI range, so about $3. That's our transportation differentials. I mean, normally it's closer to 10%. And with our drop in production and with our low rig counts and our lack of capital spending, it's hard to see us ever getting back to those levels again. The other piece in that whole picture is you are seeing mergers and acquisitions here in Canada, specifically of the bigger companies. And a lot of these guys are light oil focused, dividend type producers. And for on a simplistic basis, I'll tell you right now, if you had two sized companies that are similar and they both have similar cash flow, similar production, 1 + 1 = 2 in production. It equals 2 in reserves. It equals somewhere between 1.25 and 1.5 of capital spending. Same with the pro forma companies people. Like, it's hard, like we will not spend as much capital with the way these mergers and acquisitions are going. And that's what people are pushing for, especially in these big companies, for efficiencies and everything else. But they are not using all that money to spend capital. You're going to see more and more dividends increase. So I guess, with that said, I'm going to jump into the presentation. And this is our corporate presentation. It's on our website. There's lots of guidance in the back. I'm pretty sure Scott Koich is on the line here, which all you guys know as well. Information is on the back there as well. We're going to jump right in, but I'm going to kind of skip pieces of the presentation or talk highly on it or quickly on it and focus on some of the key pieces. But again, on the investment highlights, again, we're positioned in two really exciting plays. The economically, very economic play in the Cardium and the longer-term Duvernay play. We've been a growth company. We've been fighting some of the top growth amongst all our peers, our oil-weighted peers, for quite a while now. I mean, we're going to have significant growth over 2020, and we are forecasting in our guidance to be above our 2019 production levels. Very few companies I know, my peers, are forecasting that. So great spot to be. And we're going to have record cash flow. We already had record reserves at the year end of 2020, which is a feat in itself. One of the keys I keep focusing on, and it's one of the keys to our company, is operational technical expertise in our asset and what we're doing. And I think that's a key to surviving a fundamentally changed oil and gas industry. It's about return on capital employed right now. It's not about growth for growth's sake, and that's what Wall Street and that's what Bay Street is asking for. And we have some of the top tier cost structures in the basin and finding new production in oil and gas and getting payouts on the wells that we're drilling. You know what? I'm not going to speak much on COVID. We're past that, but we weathered that storm. We got back to business in Q4 of last year, and I think we're better than ever. Record reserves at the end of the year. Very strong NAV, which I'm going to go through specifically on a slide. Growth in all of our reserve categories. Again, a feat that very few of the companies I know in our peer group that were able to do. So we're actively working on our plan, which provides significant free adjusted funds flow through this year, which in turn will help pay down debt and get us back to a level of around 1x debt to cash flow. Real quick summary, our guidance is 51 to 5,400 BOEs a day. Our best year was in 2019, was 5,000 BOEs a day. Again, solid growth in all of our reserves. Not much has changed in our shares outstanding. We did not dilute through all of that, which was, again, remarkable to grow reserves without dilution. We got an enterprise value of about $114 million at 58 cents. I think we're 53 cents shares today. Liquidity, 155,000. You can see the director and employee ownership and large insiders there. End of the year, just under 74 million of net debt with 64 million drawn. And we got total facility capacity of 90 million. And we will reduce that here this year. Very strong technical team. All of our bios are in our website in the back of the presentation. Strong board of directors as well, also represented by some of the largest shareholders. Oh, one of my favorite slides is the production slide on the left here. Of course, the light green is our liquids growth. The orange is gas. You can see our growth since we went public in 2016. Significant growth year over year. In fact, 153% on a liquids basis. The black line with the blue squares, that's production per share growth. And you can see in the mid-range of our guidance, we are starting to grow significantly again. I wish we could eliminate 2020, but I guess that's not possible. But that's consistent with many of the producers in the world. Reserves, again, solid growth continually. Light greens proved developed producing. So that's just a straight current production blowdown case. Total proved is a certain amount of undeveloped locations. With a P90, a probability of 90% of hitting those numbers on those locations. Proved plus probable, or total proved plus probable in the orange. That is a more undeveloped locations, including the total proved, but at a probability of 50% of hitting that. So again, lots of reserves, consistently growing these reserves year over year, 33% yearly and 34% on a PDP basis and 34% on a proved plus probable basis. So that's your biggest upside base. What did we do in 2020? Again, very solid year. Record proved developed producing reserves, which is very important when you go into your lending review cycle, which of course has been a bit fickle over the last year with the volatility, but just under 9.7 million barrels. Increased our reserve life indexed over 6 years. Again, increased proved plus probable, increased all of our reserve life indexes. More importantly, our finding and development and acquisition costs. So what we drilled, our capital expenditures, our acquisitions, solid numbers, under $10 a barrel proved developed producing, $6 proved, and $8 proved plus probable. Our average peer group for the year in those categories on a proved developed producing basis was 25, 16, and $12. So right on this side here. Providing, in all categories, we're providing solid recycle ratios, which is a term for $1 of capital invested, how much do you get out the back end? So in a difficult year, significant reserves. And I'm going to talk about on the next slide how we go against our peers. And that's an important piece of business. This is our top tier efficiencies in 2020, finding reserves. And you can see in the top left corner, proved developed producing, we're number one here. And our recycle ratio in orange or yellow, depending on your screen, I guess. So blue is our finding costs and our recycle ratio is in yellow. So we're at the top of the group. And same thing on a total proved basis. And total proved is important because I believe that's where you should be trading on close to a multiple of 1 times on your total proved reserve net asset value at some point in time and get back to more normality. And second, in a proved plus probable. But you know what the funny part about this and the key to this whole thing is? A year ago, I had 9 light oil conventionally weighted peers here. 2 of them have been sold. 3 did not report finding and development measures for 2020, given the difficult circumstances during the year, and they basically didn't make sense. So that tells you how difficult of a year it was, and it tells you what we were able to accomplish in such a difficult year. Environmental leadership, we continue to drop our greenhouse gas emissions. We're very responsible in the environmental liability. We're spending, upwards of 4% of our funds flow on decommissioning of entities every year. We're running just a solid operation with everything tied in. We're using some of the government grants. That's why you see the spend this year will be 5.5%, 6% because we got some government grants to accelerate some of the decommissioning. So again, just doing what we need to do on that environmental and that corporate side of the business on the health and safety side. So again, you got the Alberta map. Our biggest area is the Cardium, and it's the Wilson Green area and the Pembina area. That's 90% of our production. It's been our focus for a while now. 5250, that's the mid-range of our guidance there. We have achieved those pre-COVID levels in production in the first quarter of 2021, so it's a solid feat there. If you take a look at our margins, chart on the bottom right-hand corner here. So the purple is the operating income profit margin, and the blue squares is WTI prices. And again, since 2016, you can see the ups and the downs and the volatility in WTI price, and you can see the ups and downs specifically in 2020 on our operating profit margin. But in general, I mean, we were increasing our operating profit margin every year, and even in 19 over 18 when you had a drop in WTI price. But at our number right now for the average for the year, it's $60.50. I mean, we're looking at being well over 60% operating income profit margin. Again, I don't care what business you're running, whether it's retail, airlines, anything. If you can increase your operating margins, that's a sign that you're running a good business. So Williston Green, this has been our major growth area in the last little while. We've slowed down a little bit here. We expect to drill maybe 2 to 3 wells this year with what we've been doing in the Pembina region and with our acquisitions there. We've got a lot of locations here. These are our type curves that we have. The orange is a 1.5 miler. The blue is a 1 mile well. And you can see the CapEx to drill the 1 mile and the 1.5 milers of 2 and 2.7 million. You could see the reserve recovered in those two categories, in those two lengths, different lengths. And you can see over the first 3 months, the initial production over 90 days, you got 290 BOEs a day, 460 for a 1.5 miler, and 365 BOEs a day, you get 145 BOEs a day, and 220 on a 1.5 miler. If you just take a look, let's focus on the 1.5 milers at the $50 to $60 price range, a WTI here. Our Canadian dollar is a little bit stronger than that. It's about 79 cents, I believe, today. But we're getting payouts over here of under 1 year, and actually, less than 3/4 of a year. And we're getting great value, great internal returns on these drills. Now, with that said, I mean, as pricing is going up, and you probably see some cost inflation here. But with that said, we got a lot of room to still have payouts of well under a year with some cost inflation. And the first one we're seeing is in the commodities, specifically steel prices are going up substantially. But again, we got a lot of room to cover those increases and still have significantly strong, quick payouts. Pembina, this has been a great little growth piece for us here in the last year and a half, and it's going to be a big focus for us going forward. We drilled Q4 of 19, 3 wells, 100% wells. We drilled Q1 of 2020 going into the downturn or into the COVID demand drop. We drilled 3 wells, and we plan on drilling 3 to 5 wells here this year. Got lots of locations, over 150 locations, lots of acreage, some decent, really good facilities there included. We just built a new facility in our acquisition. But if you go and you can see our acquisition that we did was just down here in the southwest corner of the Pembina field. But if you take a look at the production of the 6 wells we drilled in Q4, Q20, and Q1 of 2000, Q4 of 19 and Q1 of 2020. So here's the type curve. Here's our wells. And you can see where we curtailed production. So these are the wells that just came on in Q1 over here and the ones that came on in Q4 over here. So we curtailed these production over time, and they came right back up, and these wells are doing fabulous. In fact, over our type curve, our IP 365, so our production over 365 was 143 BOEs a day. Our type curves are showing 100 BOEs a day, and these are 1 mile wells. So again, we're 40+% over what our type curves were. So again, huge increases. You take a look at the economics again, $50, $60 WTI. Again, we're in that 1 year range, but that's on our current type curve look, and we're exceeding those type curves. This is starting to compete with our Williston Green inventory. So again, you're going to see us put more and more emphasis on here. We've got some great 100% locations that we want to drill, so we got total control. And I'll talk about that here on our next slide, because this gets into the acquisition that we did last fall. We cannot drill for these type of costs that we did on this acquisition. We can't add reserves for these type of costs that we did on this acquisitions. We did it on, say, 2019 net operating income 1 time. So again, matches the drilling. But we can't drill for 7,900 a flowing barrel we're more like 15,000 to 20,000 a flowing barrel. This is very low decline production. We got great inventory, as you can see here on these acquisitions. We started drilling on this southern portion here in the first quarter. We drilled 3 wells up in the northwest section here, 1.5 milers. So again, good place to do extended reach horizontal wells. The offset wells here, you got 2 going north and south. These are under a mile, about 0.8 of a mile. And we got one miler that just goes halfway, half a mile into our lands on the north end here. Here's our type curve on the dashed line. Here's the 3 wells offsetting it. And I can tell you, we didn't get reserves of these offsetting wells in our current reserve report because we haven't drilled them yet. But those are less than 1 mile or less, and they're having fabulous results so far. I believe the 1 milers have just under or just more than the reserves we got booked for 1.5 mile drills. So we got good chance for upside here. And in fact, the north well, which runs east and west right in the top corner, this is one of the best wells. It's a 1 miler ever drilled in Pembina. It's on track to do 385,000 barrels of oil and upwards of 540,000 of oil, natural gas liquids, and natural gas. So we're excited to get drilling on here. 100% working interest land, allows for full-scale development. It's a pace that's entirely within our control, and it's going to be a big part of what we do over the next few years. We're so pleased on this acquisition. I was going to say one other thing on this piece. As we continue to drill forward, it's our first round in here. We continue that we believe that we'll see other opportunities here to reduce costs and continue to make this more and more exciting and more economic as we move forward. I talked early on about our fundamentally changed business. And again, I think being a technically strong team, you see it in some of the U.S. companies. The strongest technical teams are providing the best results, and sooner or later it gets recognized. But if you take a look, these are drill curves on our 1.5 mile wells in Williston Green. And what you have here is the drill curves. And when you go from the top left corner down to the bottom right, that's our time, and that's how the drill curves go. We start, at 0 days, and we're ending here in that 9-10 day area range. In fact, our last 3 wells in Wilson Green were under 8.8 days, so continually getting better. So consistently drilling the same time frame wells, and our cost structure is up in the top corner. So this is how the costs go over time. We're averaging around 1.4, just over 1.4 million on a per well basis. But our last 3 wells, we're down to 2.4. Well, this is full, complete drill, complete equipment tie-in, 2.4 million. And they typically were closer to 3 million prior to that. Here's our look against our peers on the extended reach wells. So 13 of InPlay's 1.5 mile wells fall within the 25 fastest drilled to date in the Willie Green area. Pembina, again, best in class results here. So it's shallower in Pembina. These are 1 milers today, but we're going to start drilling on our new lands 1.5 milers. Same thing. We dropped our cost here by 25% to 1.8 million over the last year and a half. But we're drilling these wells in 4.1 to 4.8 days. This was a very long build well, so just a much longer well with the reach from the pad drilling. Again, very, very strong, consistent cost structures. And basically, 3 of the wells are the fastest all-time 1 milers ever drilled in Pembina. And basically 6 of InPlay's wells fall in the top 33, with 5 in the top 9 ever drilled in Pembina. Again, time's money. And we're getting great results on the back end of these as well. So, again, that technical piece is a big piece as you move forward, having that technical expertise, because, with the new mandate from Bay Street and Wall Street, and not growth for growth's sake, it's return on capital employed. And to be efficient means you can put more and better money to work here. I'm not going to talk too much about the Duvernay play. Again, we got a good land base. Doesn't quite match up to what we're doing in the Cardium as far as economics. But as the pricing gets better, it becomes more and more exciting. And we don't plan on doing much in here next year. But as we get our debt down to below 1, which we expect late this year to early next year or into next year, I would expect that we'll start drilling on this play coming into 2022 and beyond. Again, we'll get back into this play. So let's take a look at our forecast. We're using for the year average 60-50. I mean, I don't know, a week ago, it was less than that. When we put this out in March, it was potentially a little higher than that. We're actually there. We're better again today. As Dan pointed out, we were over $63 the last time I looked. I mean, that gives us Edmonton par price of over $70 Canadian. So on a Canadian basis, we get over $70 on this. When you take a look at our production range and our funds flow, it's 39 to 42 million. To put that in perspective, our best year was 2019, where we did 5,000 BUs a day average for the year. We did 32.5 million. So the cost efficiencies, the differentials being lower, costs coming down, NGL is getting a higher price currently than we got back then, significantly more cash flow. And this, put it lightly, includes the hedging losses that we will get for the first half of this year. So the first half of this year, is a little bit confusing with the hedging. But most of those hedges are all rolling off. We've got much more solid hedging as we move forward into the second half of the year, with very little hedging going into 2020. But that provides us with $15 to $18 million of free funds flow, and the majority of that will be used to pay down debt. So with that, we've got a capital program of 23 million, which probably moves up some with some pricing, drilling approximately eight net horizontal wells. And we end the year around 1.3 to 1.5 times net debt to EBITDA. Now, plus or minus $5 WTI, you get on a plus basis, an extra 2.1 million. On a minus basis, you lose about 3.3 million of funds flow here. And again, and that's for the year, or for the 3 quarters of the year. But once the hedging rolls off here at the end of June, that starts becoming closer to $5+ million every $5 WTI difference. So again, significant changes to the pricing. And, as I said before, record production, record reserves, record cash flow, and we used to trade $2 a share. So you can see how our industry has changed. Net asset value. This is interesting. Our net present value before tax 10% was $95 million on approved developed producing basis. So that blowdown case, 157 million on approved basis, and 264 million on approved plus probable basis. Here's our undeveloped land value less our debt. So it gets you our net asset value. So on a complete blowdown basis, that's $1.02 a share. On approved basis, which I commented that over time, we should be trading closer to, on some sort of multiple close to a total approved basis. It's $1.94. And at one time, the industry used to trade on a percentage basis closer to approved plus probable basis, but I think that's gone by the wayside. So that's $3.50 a share. But it tells you the potential upside over time. Last year was $1.70, $2.87, and $4.56. But the reserve evaluators dropped their price deck significantly year over year. In fact, I think they overcorrected. But the keys are they dropped WTI pricing by 28, 24, and 20% in year 1, 2, 3, respectively. And when they did their pricing at the end of the year, pricing for 2021 and 2022 was approximately 34% higher in year 1 and 13% higher in year 2. So in theory, I think this is easily reasonable, but probably even more on a conservative basis. So remember these 2020 net asset value per share numbers, because I want to talk on the next page, which I just threw in. This one isn't in our corporate presentation. This was independent analysis or analyst research from Canaccord Genuity, and it has all their peers in this analysis. And it's how torquey people are on the top chart on an enterprise value to a debt adjusted cash flow multiple and a debt to cash flow valuation at $65 WTI. So this came out in the middle of February. At that time, we were trading lower. We're trading at just, I think, 38 cents. So now, we're at 50, 52 or 53 this morning. But at that time, we were 1.3 times EV DAC-F 2021 at $65 and less than 1 times debt to cash flow. The dark colors are the liquids weighted companies, and they're saying over 40% liquids. I typically say you got to be over 50% liquids, but even probably if you want to be an oily weighted company, you got to be 60% liquids, including pushing close to 50% on an oil basis. But we are sitting in an undervalued position. The majority of these companies are bigger than us, of course, which parlays into to where we sit. But since then, and you can kind of see the averages in this kind of 2.5 times, maybe 2.5 to 3 times basis. Since then, everybody's kind of moved up from that mid-February. We're sitting closer to 2 times or a little over 2 times. And most of the groups are now in the 3 to maybe 3.5 times EV DAC-F, so on the bottom axis. And of course, we're getting closer to $65. So the debt to cash flow is actually getting pretty close. Tells you the opportunity there. At some point, we're gonna catch up to that group. Ultimately via what we're doing, and secondly by at some point, I imagine somebody comes calling. We're in no hurry there, so I'm not saying that's going to happen anytime soon, because we're not going to sell at an undervalued basis. This is really unique. Here's the free cash flow yield at $65 WTI. We're at the top in Canaccord Genuity's analysis. Significant free cash flow yield. So again, and this is against intermediates and junior companies, and typically the oily weighted companies have on the dark colors on the columns have much higher liquids weighted cash flow. So I'm going to just jump back to these net asset value per shares. I can tell you in the second half of the year, which I'm getting excited about, that's just over $60 WTI. I mean, if we get to 3.5 times EV DAC-F numbers, we're trading very close to this total proven number of $1.90 per share. So it's all sorts of adds up. It's all reasonable of where we're going and what's happening here. In summary, again, I'm just not going to read through this, but we're a technically oriented team, very capital efficient. We survived that COVID crisis, and we are going to set records in all of our categories. And we're going to provide free cash flow. I think we did about $1 million of free cash flow in 2019, but significantly, 10, 15 times more free cash flow than there. We did $32.5 million in funds flow in 2019. We did 7.5 in 2020 in that difficult year. And we're now talking, upwards of $40 million. We already had record reserves at the end of last year. So things are good. Again, that technical side that I talk about, that's the key to thriving in this fundamentally changed oil and gas industry. So it's been a pleasure here. I know there'll be questions, and Dan, I know you have some, and hopefully the people listening have some. And I look forward to answering them and giving you guys an update here in the second half of the year.
Okay, Doug, great. I could say, I've been in the business for 40 years, you for over 30. And, this industry can go from good to bad pretty quick, and it can go from bad to good pretty darn quick too. And I think we're headed for an extended period of good when you move to higher prices and the service costs stay low for a while. That's when you can really make some headway. But anyway, let me get to the questions. I sent you a few that I got emailed into me, but okay. In 2020, InPlay realized oil price in Canadian dollars, net of your cash settlements, was $38.60 Canadian per barrel. Okay, with WTI averaging $60 a barrel in 2021, what do you think InPlay's realized price will be, and that net of hedges and adjustments and everything? What do you think that's going to be?
So net of hedges, not including the hedges, I think. We're pushing $70, like $69, $70 is what, on current dollar FX, the exchange rate and differentials. So not quite double, but.
Yeah, but that's what you're getting. You don't have differentials in the field. That's what you're actually getting.
Yeah, no, that's including differentials.
Okay, that's including differentials. And then you have more hedge at lower price in the first 2 quarters, but then those hedges really drop off. And I think most of your hedges aren't they collars in the second half? So you got high ceilings anyway. Correct.
We've put collars on, and even some 3-way collars in certain circumstances to even extend the upper ceiling. So we again, after 2020, there was a bit more of a mandate to push for some hedging through the board and the lenders. But again, it's all been collars. I think we have one swap. Other than that, I mean, we go from, significant hedging losses and to $60 to, I think, maybe 400,000 or 500,000 of hedging losses on our forecast in the second half of the year.
Yeah. That's good. So, and at the same time, you're going to have increasing production this summer too.
The second half of the year is going to be exciting.
Yeah. The second half of the year is going to be really exciting. When are you drilling 8 wells right now?
No, we're not. We just finished completing the 3 wells in Pembina right at the end of March, just a little later than we expected. They're just in the cleanup stage. We're going to get some more information. We're going to provide more information that in early May when we provide our first quarter release. Yeah, we're kind of in that spring breakup mode in Canada where the frost is coming out of the ground and it's hard to maneuver around, and there's road bans, so you only got 60% loads, so it's extra costs and stuff. So we typically don't get too carried away in this time frame. But I mean, so far breakup's going pretty good, and usually the road bans end, so we don't beat up all the county roads and the government roads and usually the end after the May long weekend. So, I mean, as it sits right now, we're hoping to get back drilling, end of May, early June, and having production come on by the end of July, give or take.
Okay. And where are natural gas and NGL prices? Because as we discussed before we got on the line here, boy, NGL prices have really rebounded in the U.S.
Yeah, I mean, like AECO's AECO's our natural gas price. I mean, it's trading around 250, 260 GJ for the summer, working its way up to 280 in the winter, which on a MCF basis is, you can add, give or take close to 10% for that. So 270 to basically back to over $3 an MCF right now for the winter months. So again, yeah, big change there. It's funny. I mean, because we're close to 70% liquids, it doesn't change our revenue too much, but it all adds up, right? And it's a pretty good piece of business. And again, I mean, NGLs is very focused to the pricing of WTI, and we're typically getting, I would say right now, around 40% on when you put our whole NGL batch together, about 40% of WTI. Maybe pushing 45% here at times. Propane's been very strong, and butane has been weak. And then, typically condensate, and then the pentane, so the very high light ends that's used for diluent and stuff, is getting a premium to WTI. So, that's where the average stands.
Okay, good. Let's see. One question here was, do you have $65 million of debt due in May? It said, what are you going to do about the $65 million debt due in May?
Well, again, we're going through our lending review right now, but with
that's your bank credit line, right? That's
our bank credit line. We do that every year. And again, last year was a difficult, challenging year. They had very low price forecasts. We worked our way through that. We've already we already submitted everything to the lenders. We've had initial dialogue with them. I mean, with our increase in proved developed producing reserves, which very few people have done, and the significant increase in their price deck, I imagine. Our initial indications that everything will be just fine there, and we get back into a fully conforming $65 million loan plus the $25 million BDC line, and working our way back down to in the low 60s here for the end of the year, give or take.
Yeah, and since you're not drilling anything now, you're going to be generating a lot of free cash flow in the second quarter, so you'll be cashing up to have cash for the summer drilling program, won't you?
Yeah, second quarter we'll be free cash flowing. The third quarter we'll be free cash flowing in the fourth quarter, even with our program on strip pricing and well below strip pricing, we'll still be free cash flowing. $55 we're still free cash flowing. $50 we're still going to show free cash flow, but again, of course, less.
Yeah. For our listeners too, on these bank lines of credit, they're reviewed each year, but if you've got increases in your proved reserves, and especially if they've increased their price decks, they're not going to call banks are in business to make money loaning money. So they're not going to call, your bank line of credit if you got a free cash flow company here. So anyway,
let's put it this way, Dan. If they were going to call it, last year was the year they were going to.
I know last year they would have done it.
Right. And they're not they're in the business of working with you and getting through. And as you commented, last year was the most difficult year that I've ever been involved with. Because you just didn't know how long that that demand destruction was going to last. And then, again, coupled with, the OPEC little war that started, OPEC plus war that started, it put us in a position that like, again, we didn't know how long that would last. I mean, if that lasted any length of time, like our whole industry would have been a mess.
Oh, yeah, I know. Yeah.
Cooler heads prevailed in a short period of time here with those guys to, go well and beyond the cuts that were there prior to the demand drop. So, again, the lenders are, we got a good relationship with them. You got to remember our mandate when we got the BDC loan was to get to pre-COVID levels, production and reserves. Well, we exceeded reserves already. That was our mandate from the lenders. And we now are, back to pre-COVID production levels. So we're in a great spot.
Yeah. This is a good time to also talk about reserves. When you look at year-end reserve reports, and all these public companies have to have their year-end certified, like by third-party independent reservoir engineers. And these guys are very conservative. I did this at Hess. We use Netherlands Sewell and McCormick and them, and they're very conservative, and they can only give you the reserves that you plan to develop in the next 5 years, and they have to use trailing prices. So the year-end reserve estimates at the end of 2020 are extremely low, and they're not based on $60 oil. So the upside here for a lot of the companies that I follow is they're going to have a huge increase in the PV10 value of their proven reserves at the end of this year. I mean, it's going to be like double for some of these companies.
Well, I mean, they moved up some, but again, I think in the first 2 years they were a bit low. So again, they hopefully, if the volatility changes, that'll move up. And they used to be too high on the pricing side of the equation, and this year they over adjusted in my mind, and I think most people mind too much. But yeah, again, it should go up again, and it the volatility of it all is what's caused a lot of those problems. Like it just, let's face it, it's been so up and down that it makes running a business difficult. It makes their job difficult. Their mandate was to try and get back to some sort of realistic value. I mean, that's probably, again, that's why our NAV looks so big in 2019, because the value of that was so much higher, even though we got more reserves this year. So again, I mean, if you get back to something like 2019 reserve valuations, you could look at my 2019 net asset values and see what that might look like. And not only that, of course, I had more actual reserves in all three categories, so could be even higher. So again, it gives you an idea of how that goes. I mean, I think that the reserve evaluators do a pretty good job on the PDP, proved developed producing basis. I think where the conservativeness starts to really come in is on the undeveloped locations as you move forward.
Right.
And until you prove them up, I would say the majority of the time you're getting technical revisions to the positive as you move forward.
Yeah, and also, and their reserve report is based on your type curves, right?
Actually, so the reserve report is actually under our type curves in many cases.
Right, that's what I mean. So if your wells outperform the type curve, they're going to raise the cover wall too.
Yeah. Oh yeah, exactly. Like we had even in Pembina, we had strong on those 3 wells we drilled in November in Q4 of 19, and the 3 wells we drilled in the first quarter of 2020, we got significant increases, technical revisions upward in those reserves, which then again helps upward revisions on your undeveloped locations around there.
Right. On the whole field.
Yes. Yeah, there's a snowball effect, right?
Right.
In that area. I mean, it's the same thing, like you say, conservative. If you step out, a few more miles out of there, or a mile or two, like they'll get conservative again. But as you move closer, which isn't a bad thing, right? I mean, and then that's kind of why you've got the difference between proven and proved plus probable, where they risk the proved plus probable undeveloped locations even more, but it does give you an idea of what your potential is as you start moving, categories from probable into proved into PDP, right? So that it's a step change in the dynamics of it, where the measure of risk, right, as you go through that. But if you can move those forward, it gives you an idea of what things look like.
Yeah, I mean, on every one of these calls, we're getting asked about the impact of the Keystone XL pipeline. But there's a question here: what is your exposure to Line 5 permits and other shipping and differential risk?
Yeah, well, so that would be it. It's all about the differentials. It's all about the differentials. It's our risk. Like, I mean, I'd be surprised if a lot of our oil even leaves the province. I mean, I don't really know. I don't know where it goes. We sell it to, typically bigger companies. The marketing groups of bigger companies. As soon as it leaves our pipeline or our truck at a terminal, it goes into a major pipeline, and they decide where it goes. We pay, 25 cents, for them to market it. And we pay the transportation differential. So I mean, what is our risk? It's all of the differentials. And I mean, is there risk there? Yeah, I believe there is risk there. I think smarter heads prevail. I mean, this line's been in service for 70 years. Secondly, that line provides a significant amount of propane to that Michigan and that Midwest area. I think the governor there, she had a state of emergency for lack of propane during the cold spell. So, where are they going to get that propane from? That line, I mean, so this week alone, you've had the resource minister in Canada and the federal government. He was talking directly to the Biden administration and basically, saying this is a non-negotiable piece. Like, if you want to, we'll deal with new pipelines as they come. But to shut in the other piece of that goes, that line 5 goes down into the Midwest, into Michigan and the Chicago area. And then it actually provides product up into the Southern Ontario, which is the most populated area in Canada. And specifically Toronto Pearson Airport, the biggest airport in Canada, is getting fuel through that line. So again, there's going to be significant diplomatic relations here that are going to have to occur, and I believe they will occur. And again, I go back to, it's hard to fathom that they will get that changed, and specifically when Enbridge wants to do things there to build bore a tunnel and even make it more safe through the waterways that they're worried about. So it's an interesting piece.
Yeah, when I was at Hess, we were a major supplier of propane into Minnesota. We had a cavern up there. We stored like 3 million barrels before the winter, and it drained it completely every winter. Because what people don't understand, rural people, they heavily depend on propane for heating and cooking. Heavily depend on it. And it gets freaking cold up in Michigan and Minnesota too.
Yeah, I don't know what would happen if she killed a few of her constituents in the winter when they freeze to death. That's not going to be looking too good.
Yeah, that will look good at the next election, I don't think. Let's see. I was going to ask you in the Duvernay shale play, and I think there's huge upside for you. If we get oil settles in the mid 60s, 70, where I think it's going to end up going, then what happens in the Duvernay shale? How do you see that evolving for InPlay?
I would say we start drilling next year because we'll have lots of cash flow. We will start drilling there again next year. We've got ideas to drop the cost structures in there. Mm-hmm. Stuff we've learned in the Cardium that we think will definitely pertain in the Duvernay. Some of those ideas are being done in the deeper, higher pressured areas in northwestern Alberta and the Montney and stuff in the Duvernay. So we think, other guys in our area, the Duvernay, have not tried that yet. They've kind of stuck to the knitting that's been working. But we think that, we've got some great ideas that will reduce the cost and even make that more economic. But again, next year, on a $65 plus basis, I would say we will be drilling in the Duvernay.
Is the other industry players drilling around your acreage?
Yes, private guys. Yeah, private guys, and very few public guys. It's their 100% play, and they've got relatively patient private equity money. I mean, it was patient. You're not seeing a lot of new private equity money come in the basin, but this is older companies, and they've started drilling again. And I think on the one chart in my slide there, you've got around our area. That's one company. And basically you could see when they shut in during the COVID time, and they popped it right back into the to the levels they were, over 8,000 barrels a day in the fall of last year. And they're drilling right now and licensing wells. And just on the other side of the reef, you got a company called Vesta, which is 52% owned by my major shareholders that own 30% in us, and then they're back drilling as well. So it's coming back, and it'll be a key for us as we move forward. It was always been a long-term strategic play. Just doesn't match the economics of the Cardium right now. We want to get our debt down below 1 times. And again, as we have continued free cash flow, some of that will start getting maneuvered over into the Duvernay play.
Okay. A couple questions here in the chat room. Are options traded on your stock? I don't think so if it's at 50 cents.
Yeah, no, I think we're too small for options.
Too small for options at this point. Okay. What's the average interest rate on your debt?
So it's there's 2 pieces to that debt. So that's why, guys have used RBL, or reserve-based loans, lending loans, over the years. And that every year you got to go through this process, right? And they set a new price deck every year, the lenders. And so that one is typically low, but you're on a bit of a matrix on your trailing debt to EBITDA. So currently we're probably in the 4.5% range. We've been down more in the 3% range when you had a lower debt to EBITDA, trailing EBITDA, so that 4.5 should start coming down. And then our 4-year term loan is so that's $25 million of term debt. There's still 3.5 years left on it. That's kind of in that 6.5-7% average range over the life. So it's a little bit higher, but it's very, very cheap for a company our size to have a term loan of 7%. On a piece like that. Like typically, when I've ever looked for a term loan at a company our size, and kind of our bond rating, whatever you'd want to call it, which isn't public, but the lenders would have it. You'd be lucky to get something with under the double digits, right? So that was a great loan, great piece.
Yeah, it is, and yeah, be interesting to see what happens at the end if they just let you roll it over or something. But by then, I mean, you should have 8,000 or 9,000 barrels a day production or something. Should be great.
Yeah, and I mean, if your debt to cash flow is lower, like it should all roll into your RBL line and everything else. And the other piece is like the Business Development Bank of Canada also go into syndicates, so they could participate in the syndicate coming out the back end as well.
Okay, all right. I think that's it. Okay. We will be publishing an updated profile on InPlay. Hopefully I can get that done next week. And I went on a little vacation down to Mexico, Doug. So I took some days off. So I'm behind schedule here. But anyway, you have to get your COVID. You have to get COVID tested before you can get back on the plane. Yeah. And I asked the gal that handles our travel, and she said, "Has anyone tested positive?" She said, "Nope, not one person has tested," which is almost unbelievable. But they haven't had to put anybody up for a couple of weeks or anything down there.
Good for you, Dan, because I mean, up here in Canada, you go and travel on a plane down south anywhere out of the country. You get tested before you get on, so you get off, and you actually basically got to go into quarantine for upwards of 4 days in a government hotel for about $2,000 more of your expense on an individual basis. So even if you and your wife went, you'd each have to have your own room for $2,000 each.
God.
Just add that to the top of your vacation. It's okay though if you just fly to say Seattle or something, and you drive across the border, you just can drive across, get tested, and self quarantine at your house. So yeah, it all makes sense.
Yeah, I know. And someday historians will have to make sense of this, because I don't see it at all. But anyway, all right, man. Well, hey, encourage everybody, get your second vaccine shot, and we'll all be safe, and we can start getting back into real world again. Anyway, hey, thanks a lot. We'll end it there. We have recorded this. We'll be sending it out to all of our people around the world no later than tomorrow. Anyway, thanks a lot, Doug.
Thanks, Dan, and forward any questions to us anytime, any of your people, right? And Scotty, myself. Thank you.
Okay, bye-bye.
Have a great day.